Starting, all attendees are in listen-only mode.
Hey folks, hi. This is Raleigh White with Westmark Trading, and I'm pleased to kick off. And we've got a few folks that are just piling into the room here. So what I'm going to do is give us about 3-4 minutes to let some people get in here. The markets are closing, they're wrapping things up, and then we'll get going. So it's right now 3 o'clock Central, 4 o'clock Eastern Standard Time, and we'll be starting in about 4 minutes. Just want to make sure that we have enough. All of today's presentations are being recorded, and everyone that has registered for today's webinar will receive a link to these recordings in the next day or so. Secondly, our presenters are going to address any questions that you may have during pauses in their presentation or at the end. But don't worry, please type your question in at any time into the question panel, and we'll make sure that we monitor these and answer those before we wrap up the webinar. And lastly, you may want to put your webinar display in full screen mode for the best viewing experience. And so with that, let's get right to the reason why we're all here. Now, our first presenter today is Mark Sebastian, and he's going to be talking about managing risk using options. Now, Mark is the founder of Option Pit. He's a popular author, he's a TV personality, and a former member of the Chicago Board of Options Exchange and American Stock Exchange. He specializes in using risk management for consistent results. And in today's presentation, he's going to be sharing strategies for building a portfolio and turning trades into profits, managing money like a pro and avoiding pitfalls that hurt many traders, and lastly, risk management techniques to keep more dollars in your pocket. And with that, please join me in welcoming Mark Sebastian to our webinar.
Hello! Good to see everybody. It's good to be here. I'm a happy camper because I've got this great audience, and I'm here with Dan Cook. I'm here with Raleigh White, the two finest gentlemen not related to me that I've ever met. So we're going to talk about how to use options as investors and some risk management stuff, because I feel like a lot of traders don't really know how to manage their risk. And, just briefly about myself, I was a floor trader for about 10 years. I traded probably 500-600 stocks from, little biotechs you never heard of to the S&P 500, which maybe you have heard of. If you've not heard of the S&P 500 and you are at this webinar, you may leave. You don't need to be here. In addition, after I left the floor, I started Option Pit. We're an education and consulting firm. We work with individuals, teaching them how to trade like professionals. And I put my money where my mouth is as I manage a couple of small private hedge funds. So what are we going to cover? We're going to have a covered call checklist, a cash secured put checklist. Oh, this is the wrong presentation, folks. I am looking for this one. So I'm going to talk about what is risk management. I'm going to talk about money management plan, a trading plan, and ways to use options as a risk mitigating tool. The other one was really good, but that was for paying clients. You aren't that lucky, unfortunately. So one of the things I always thought was funny is looking up risk management, and I put risk management in the Merriam-Webster dictionary and nothing came up. It didn't come up as a definition. Risk management can be all kinds of things. We had a risk manager in college, believe it or not, and in my fraternity, he was not very good at his job. So my definition for option traders and investors is, and this is the way you should think about it, taking of risk in the most capital efficient manner, as such to receive the highest possible return for the fewest amount of dollars. That is the way you should think about risk. You should like risk, but it should be efficient risk. So how do you do that? And that is with structuring your trades the right way, using management tools on your risk, and efficient use of capital. One of the biggest sins I see in traders and investors is they're completely inefficient. So let's start with understanding risk. Before flying a plane, pilots must go through extensive training as to how the plane actually works, right? So my first cousin flies for American. A year of classroom time before he got behind an airplane. My best friend flies helicopters for the Army, and he had, constant classroom, and he still has to go through classroom stuff, even though he's a lieutenant colonel, because he needs to keep himself up to date and educated. So the reason for this is that when you're flying a plane, you're prepared for what could happen. If you don't understand how the plane works, even if you know how to fly it, when something goes wrong, you won't know why or what to do. You'll experience what we call pilot error. So where do you start with risk management? And this is the key. You need to understand an instrument. All right. So how is an option different from equity? How is an option position different from another? And this is the key. Learn the workings of an instrument intuitively. What does intuitive knowledge mean? What does intuitive knowledge mean? Right, it means that you understand things instantly and automatically. Right? It's like riding a bike. Once you've learned how to ride a bike, you can ride a bike intuitively. Last year I'd not been on a bike in 3 years. I'm teaching my kid how to ride a bike, and I picked up the thing and got right on. That is intuitive knowledge of something. Understanding its inner workings without really having to think about it. And if you can do that with options or any instrument, that is going to put you in a position to succeed. If you can't do it, then you need to work on your knowledge. All right, I can always tell whether someone understands options if I ask them a question and then I see their eyes look up while they think about it. If you have to put your eyes up and think about something, if I ask you a basic question, then you don't understand options intuitively and you need to study more. Do you understand the basics, the quote, the expiry, synthetics? Do you understand how the pricing model works? Do you understand how the Greeks work? And do you understand non-modeled risk? Non-modeled risk is what gets most option traders. They're so used to looking at a stock risk graph to figure out everything they're doing that when that risk graph doesn't work, they don't know what to do. They panic, and it turns nightmarish for them. So why do you need to know theory? Because these risk graphs that you see on Thinkorswim or on whatever Lightspeed, they look great, but they're built on models, and models were built to fail. So you have to understand the model before you can understand how to accurately manage risk. So it's annoying, but if you save the shortcuts for later and learn the stuff, you will be happy. All right. Understanding the causal risk is the key to risk management. It's amazing how many people I'll be in this discussion of like, how does this make me money now? And the answer is you'd never make money now. It never happens. You make money through work. And if you can't figure out how risk actually works, you're never going to make money. You may have trades that make money, but you will never make money. It's amazing. People spend more time reading the directions on a box of Velveeta shells and cheese than they do really understanding options when they're trading their own money. Risk can change. So this is actually modelable risk, but I want to show you why this is important. This is the S&P 500, and it's got different conditions. It's got a current P&L. It's got a forward P&L. So what's going to happen in a few weeks? It's got a change in volatility. And you can see changing conditions can change my graph. It can change the entirety of my risk. So another thing is you need to understand the contract you're trading. What are the dollar risk? What is the multiplier? What does it expire into? When does it expire? And that sounds easy. But let's think about the S&P 500. How many different ways are there to trade the S&P 500? in, either in options or futures. So let's do options. So just options, there is options on the spider that expire into an equity. There's options on S&P 500 futures that expire to futures or expire into cash. There are options on the S&P cash index that expire into the cash. There are mini options on the S&P 500 that expire into cash. There are, other multitudes of ways of trading the S&P 500 via options. So just something as simple as that is actually much more complex. So now that I've established some basics, you need to know what you're doing. If you don't know what you're doing, and I mean intuitively, don't trade. Spend a month or two really learning options. If you don't trade for 2 months, spend that time really learning options, you will actually make money faster than someone that starts trading right away. So, once the trader is actually ready to trade, the next step is to build a money management plan. A money management plan will allow for how much of an account will be engaged. How many of you think about how much of my money am I putting in on every trade? How am I allocating my dollars every month? So what kind of money do you have to work with? What is your goal rate of return? How can you allocate capital so that you're able to achieve that goal rate of return? All right. Can this be done without the risk of blowing up? All right. Is the plan efficient? And does the plan scale? And I'm going to hit each of these. So let's talk about the money you have to work with. Different accounts warrant different type approaches to trading. But, and this is a big mistake traders make when they're starting out, don't treat any capital lightly. All capital is a part of building a success and wealth. There's no such thing as throwaway capital. I don't care how rich you are. Treat every dollar as if it matters. I mean, I've heard probably 500 to 600 people say over the course of the last 8 years I've been doing this, oh, it's only a $5,000 account. All right, so basically, if I blow 5,000, who cares? Which is just bananas to me. If you gave your money to a financial advisor, $5,000, and you said, and he looked at you and said, well, it's only $5,000. What would you do? You would fire the guy's butt in 2 seconds. Yet you don't hold yourself to the same standard. You need to hold yourself to the same standard as you would hold someone else who's trading your money. Same thing with that knowledge base. You wouldn't give your money to your 16-year-old to just bet on. Right? You wouldn't give it to a financial advisor that doesn't care. So, I always like to say, okay, what can I buy with the $5,000? Right? I can either blow it in a trading account, or I can buy this sweet 2000 Ford Mustang for $5,000. I mean, look at this thing. It's got an air scoop. It's got some pretty sweet tires. Right? It's black. It's pretty sweet. So it's I'd rather have that than blow $5,000 in a trading account. So now let's talk about return. Be aware of what is a realistic number. What is a realistic rate of return? Is 5% a month? I just want to make 5% a month. Is that realistic? It's 80% a year. How many traders do you think make 80% a year? All right. How many funds do you think make 80% a year? Not many. All right. Is 2% a realistic rate of return? That's 26% a year. Be realistic. Having the right expectations will help you avoid making silly mistakes. Which gets us to another point. How much of an account should stay in cash? How much of an account? You know how much in my one fund, we are 90% cash most of the time. All right. So now let's go back a step. Remember, I want 5% return. That's 80% a year. Well, I always tell people they should stay about half in cash. So that actually means with your allocated capital, you're trying to return 160% a year. Does that sound realistic? Sounds realistic for about 1 out of every 600 of you. So now, ceteris paribus, how should capital be allocated into each trade? All right, that means all things being equal. So if you take, you're going to have 5-6 trades a month, and each trade you're assuming you're going to do about the same on each trade, then you kind of allocate your capital. So when allocating capital, one can mistake for the too much of a good thing approach. I sell iron condors every month, and that's all I do, and I put all my money in it. You will not last long. I'm sorry. You're going to go out of business. You need to be diversified. You need to have trades you want to be long in, trades you want to be short premium in, long premium. And you need to be aware of your maximum loss in catastrophe. What happens in a catastrophe? How much do you lose? So you need to take appropriate steps to make sure that you're always able to trade. That should be rule number one. Rule number one is no matter how bad things are, you are able to trade. All right? And then never be short units. All right? What are units? This is a floor trader term. Units are options that are super inexpensive. All right? The amount of So basically, if an option becomes worth less than 20 cents, close it. Close it. Buy it back. All right? Never be short units. Those little baby options will cost you. I can tell you 2 stories. One good, one bad. I was trading an Irish biotech called Elan, and I looked over my position and I realized I was short a bunch of the 20, 22, and 17.5 puts at levels between a nickel and 20 cents. And I said, well, why am I short these? They're tying up a bunch of capital, and I'm not going to make any money on them. So I closed them all. I ended up closing, I spent, it was about, 800 options. I closed them all for between a nickel and 20 cents. I ended up spending about $8,000 to close them. $800, sorry. $800 or $900 to close them. Anyway, so 2 days later I walk in and the stock is down 90%. I made like $175,000. Not bad. Not bad to walk in the morning up 6 figures. Interestingly, I had something very similar happen to me the other way, where I did not close a cheap option and the underlying rallied hard. I didn't close some short calls. The underlying rallied really, really hard, and I lost like $250,000. So, never be short units. This is one of my market making days, by the way. So now the next question is it scalable? A real trading approach should be planned for $2 million or $200,000, not $20,000. If you are just trading a $10,000 account, you need to think about it as if, would I do this if I was trading 100 grand? Would I do this if I was trading $1 million? And if the answer is no, then it's not a good trade. If you can't scale it, it's not a good plan. Many retail traders take far bigger risks on small accounts because they don't think in scale. Next is the trading plan. This is the nitty-gritty of our capital approach. So you start with all trades are kind of tradable but not in spectacular conditions. Then you develop kind of a rating system for how good a trade is, and you allocate capital appropriately. And you put into place restrictions on loss and gains, covers, adjustments, and insurance. All right? You're going to use something called VAR, which I'll get to in a bit. All right? Finally, you adjust your allocation according to what trades are favorable. You find edge. That's trades that are better than others. So if like a butterfly is statistically favorable, you do more of those than a calendar. Or you allocate more capital. If you don't want to do a condor or a long straddle, and it's not good conditions, don't. And it's good to have cash. All right? So, what is VAR? VAR stands for value at risk. And you need to have the number one thing you can do is to set value at risk limits for every trade you do. How much of my account am I putting at risk? So in my vol fund, the most value at risk I'll put into a trade is about 10%. Right? Why? Well, while my trades are statistically likely to win, I need to be able to repeat the process. So I need to be able to do multiple trades of that high probability trade because I could lose 1 or 2 or 3 months in a row, and I need to have the capital to trade into it. So this kind of loops back to understanding options intuitively. You need to learn to pick good trades. All right? Anybody that says, I do this on this day of the month or with this number of days to expiration in the rut every month, I go, oh, here's somebody who's not going to make money. Right? Who here has heard that there's a great edge in selling premium? That selling premium is money in the bank. You can't lose. Who's heard that before? Right, all of you. There's some famous people that have some internet shows that preach, sell premium, do a lot of small trades and you'll win. It's a load of hooey. My friend Russell Rhodes, who's at Tab Group, did a study on earnings trades. He did So the saying is 80% of options expire out of the money, which is true. But what they leave out is how much money those 20% that end up in the money make. There is almost no edge in premium selling. The edge in premium selling basically outpaces a treasury. It does not outpace the S&P 500. So, it's not a great strategy to just do over and over and over and over again. You will make a tiny amount of money. Especially if you're doing it kind of unilaterally. Right? If you put in a system to find stuff to sell and then find stuff to buy, then you'll be in a position to win. But if all you're doing is blindly selling premium every month, you will congrats, you'll make 3.5% a year. Way to go. You officially can be a certificate of deposit account at a bank. Way to go. So, how do you enter good trades? This goes back. Take the time to understand what is a good trade. Build an adjustment plan and a closing plan. So, what is the key to a trade plan? Write up the optimal conditions, the normal conditions, and no trade conditions. Write up an adjustment plan for any conceivable move. Underlying rallies and the implied volatility is down and falling. Underlying rallies in the IV and the implied volatility is up and rising. Underlying falls and the implied volatility is up but falling. What are you going to do? What are you going to do? What are you going to do? You should know all this going into the trade. So set a max loss and an absolute max loss. The absolute max loss is that you'll never allow a trade to fall under any reasonable scenario. This is kind of where you're looking at what I call gap risk. Gap risk is we settle 30 bucks in a stock, you wake up the next day and it's 23 or 39. Makes a 30% gap or a 25% gap lower. All right. Max loss might be your target profit. Absolute max loss might be the total amount of cash you took in. Things like that. One of the problems traders have is what to do when a trade is down but not at maximum loss. You just need to make adjustments so that you don't wake up tomorrow and if you blow up, if the underlying tanks, you're down huge. It'll save you money. Never throw capital at a trade. Dumbest thing I see. I put on a butterfly using 5,000 bucks of capital. Well, it's not going my way, so I'm going to add 5,000 more and 5,000 more and 5,000 more. Next thing you know, on a $5,000 trade, the trader is down 15 grand. Try to add as little capital as possible when adjusting. Keep return targets and maximum losses off of the original trade. Never open up a cheap option. Don't buy or sell inexpensive stuff. And stay contract neutral. What does contract neutral mean? That means if I had a 10-lot butterfly, that's 20 contracts. When I make an adjustment, I'm still carrying long and short only 20 contracts. If you have to add, you can add like a call or put buying one. You know, I'll do that. I'll buy a call or two to clean up delta. But not much more than that. Try and stay contract neutral. Any questions on kind of that risk management thought process? Good. So now, covered calls. An over a stock this is great for stock ownership. All right. An owner of a stock can increase returns by selling upside premium. What I like about it is it sets a level to get out of a stock. It produces income on a position, sets a top for a long position, and saves the trader from thinking about the out. It's a unique position. This is a covered call on like Apple. Right? You're long the stock and you sell the call. This is also called a buy right. You buy the stock and write an option. This is what the risk looks like. So why do I like that? All right, so let's talk about the two big mistakes stock owners make. One, they fall in love with a stock, right? A stock is never going to kiss you back, right? You're never going to be making out with a stock and it slips you the tongue, right? All a stock is a receptacle of value. It is a holder of wealth. It can go up or down. But don't fall in love with it. You have no idea. There is like a cult of Apple, a cult of Tesla. I'll tell you, I wrote a bearish article about Apple, and people would have sooner. I thought I insulted their mothers. In fact, they were nicer than me than if I'd insulted their mom. So by selling covered calls, it will actually force you out of a trade, right? And if you're thinking about tax, you're thinking about things the wrong way. Income is income. So sell calls against your long stock and get out of the trade. There you have that risk. The nice thing is I buy the stock and I sell the call at 170, and my P&L is the stock going from 166 to 170 and the $3.60 I collected on the call. If it goes to 174, I don't make any more money, but who cares? I made $700 real fast. Now, puts are even better. I don't know why people buy stocks when they can sell puts. Puts can be used to set entry and exit points. Buying a put will set a floor, but it has a cost. I don't really like put buying except for when I have concentrated wealth. So I'm an employee of Westmark, and 80% of my wealth is in Westmark stock. Well, then I should buy puts. Other than that, I'm not a huge fan of hedging, except for in a just-in-time basis. Just-in-time meaning the market's starting to look ugly, I should hedge. All right? I don't believe in hedging when the market's giving you the all clear. Purchase puts do not make you money. They will preserve your wealth, but they don't make you money. Now, puts, on the other hand, are great for setting up entry points. If you're not using puts to get into stocks you like, you're missing out. Traders can sell puts in names they want to own, collect the premium, and then hopefully buy the dip. Apple, for instance, can be a truly great buy the dip stock within reason. So I actually want to show you something. So I do some writing for TheStreet.com. Me and my boy Jim Cramer. Waiting for this thing alone. On that dip, who remembers when Apple absolutely took a nosedive? I'm assuming all of you. That's not me. Oh, hey, Carly. There's me. You know, Nike was one I was saying to buy today. And I want to show you Apple on that dip. All right. I was saying sell the July 145 put at $13.50. All right. Well, let's take a look where that is today. Stock's a lot higher. Let's go to July. The 145 put is now $2.13. I would have loved to have taken delivery for a 132 131.5. I didn't get to. But that's the type of stuff to do with puts. And here is what a protective put looks like. You notice it looks a lot like a call. And here's what that put sale looks like. In this case, it's a put spread. You know, you can actually set a floor with a put by buying a way out of the money, and then you're going to be out of it as what we call a credit spread. So now the final one is the risk reversal, and this is, again, great for concentrated position. It's a good risk-off trade, and you can set up strategically. So this is when I buy the 160 put, sell the 170 call, and buy the stock. Well, what do I like about this? I've got a floor, I've got a ceiling, and I've got a credit in my pocket. So if Apple sits here, I'm going to do great. If it rallies, I'm going to do well. And if it falls, I'm protected. Looks like this. Sometimes called the collar. So, use put to enter, not exit. Learn to use options for stock trading. And all capital is precious. So, real briefly, we did a class called Options for Investors. That was what I had up earlier. It's about 4 hours long. We got into the Greeks. We got into expressing investment decisions, how to really deeply into how to create income with weekly and monthly options, and managing risks like a professional. It's $297 in the store. I'm going to give you a $100 rebate if you buy it between now and next Monday. And if you use code 25_off, OFF, by the end of the day tomorrow, it'll knock off an extra $25. I'm also going to include 1 month of access to my chat room for free. So all told, this is about a $500 value you're going to get for $172. Go to optionpit.com/riskclass and you'll get these recordings. All right, pretty darn awesome. All right, any questions? Any questions for me? If not, all right, you go to optionpit.com/riskclass. If not, I'll hand you off to Mr. Cook. How does your work tie in with Nadex? I think Nadex is an excellent risk management tool. And, you know, some of the things I talk about in terms of value at risk and setting your profits and losses, using covered call strategies, binary options are great for that. And there are some really cool things you can do with binaries that, you know, just automatically create risk management for you. That's how it ties in. Nadex is kind of Nadex is kind of like built-in value at risk. Is that a fair assessment, you think, Dan?
Yeah, absolutely. I actually had a note from when you were talking at value at risk, because that's risk management is really one of the whole premise of this exchange.
Right.
And it really is. I mean, you understand a lot of the things that you were talking about as far as part of the plan. What's your risk of blowing up? Well, now, if you put your entire account at risk on one trade in any market, well, you can lose all of that money. One of the things I'm very proud of, and I was talking about earlier today with a few of the newer people here, was the importance of not being margined, not blowing up to the point where you not only lost your entire trading account, but where now you've got to come up with other funds because you owe your broker a bunch of money. That just doesn't happen at Nadex. And there's plenty of horror stories out there in the market.
Yes,
but yeah.
Tell you some.
I know you can. I know you and I think, gosh, I've probably known you at least a decade, if not more now. I think, yeah, we did a radio show in Las Vegas
Yeah,
ages ago.
yeah. That's got to be almost 10 years. Yeah.
Yeah. Oh, I can't believe I'm still only 27. Or, well, maybe, yeah, maybe my math isn't so good. Um, but yeah, no, actually, that was a great explanation of Nadex, and you nailed it, Mark. And that was awesome, awesome presentation.
Thank you.
As you know, I mean, I think one of the great things just about options, whether they be the traditional options or options, the types of options offered at Nadex, is using them as risk management tools, and nobody will be successful. I mean, I know everybody wants to get in this market to make money, but until you actually learn how to manage your risk, or actually what I say is until you learn how to lose money sensibly, you'll never long term make a dime.
That's so true. That is
Cool,
so
cool.
true.
Definitely. Well, thank you very much, Mark. If more questions come up for Mark, if you want to
Here.
hang on here,
I want to see what Dan Cook has to say, because Dan Cook is my hero.
Oh yeah. Thank you very much, Mark. I'll have to buy you a drink this summer when we get together for that event.
Yep.
Or two, or maybe you've already been drinking today, and that's why you'd make a comment such as that. But yeah, real quick, one of the reasons that we like to take part in these webinars, and the question is, how does your work, the one that you just answered, is how does it tie in with Nadex? Well, there's a lot. I know, Mark, you've looked at binary options for a while, but really the whole premise of trading. One of the reasons we love to do these events, even though the actual products may not be directly, that Mark was talking about directly, they can be associated with Nadex, but the whole premise of risk management. And when you can expand your overall trading arsenal, that's what we shoot to do with our members here at Nadex, is to give them tools. I've learned as much when I was back in my my Forex days, when that was pretty much all I was doing. I learned a lot from futures traders, guys and women that were trading oil, or maybe they were trading treasuries. So even though I wasn't trading specifically those products, the same premise hold true. And so that's one of the reasons why all of this ties in, because when you can learn about different markets and trading, you can take that knowledge and apply it in a lot of different areas of trading and in your life. I mean, there's so many lessons in trading that just relate to life. For example, everything I look at, and Mark, you're probably the same way, basically every time I look at anything, I'm like, what's my risk? How do I define my risk? I was giving a presentation. I promise not to tell. I'll make the story quick. I was just starting a presentation. I was at a trade show, and it was about 2 minutes out, and I was talking with the audience. And my wife texted me. She was planning a trip with one of her girlfriends to be out in Las Vegas. They were going to go see some shows and stuff. And she sent me a text saying, "Hey, can I extend my trip for another day?" And so I, before I answered, I asked the audience. I took a poll. And some of the answers came back. Yeah, sure, let her stay an extra day. The other ones were like, oh, no. And so I asked the audience, and I'll ask you guys, what do you think my answer should have been? Do I let her stay an extra day, or do I say no? I'd prefer, if you came home as planned. And I'll be able to tell from this answer who's married. And Mark probably already knows the answer. And yep, quite a few of you. The answer is, of course, yes. She can stay that extra day. Do you know why? Because I can very well define my risk in that scenario. It's going to be another night of a hotel. Maybe there's a flight change fee. She's not a big gambler, so there's some dinner. I can define that, right? There's really not big upside for me, which obviously in a trade we'd want the upside. I mean, the upside, maybe there's going to be some upside there, but I could define the risk first, the most important part. If I say no to her, and if you've ever met my wife, I don't know what my risk is by saying no, right? I still have to sleep next to her. So, and I sleep pretty soundly. So obviously, and that's why we look at in everything in life. And that's why trading is so important, and understanding your risk, because it does translate throughout. So with that, and sorry, I kind of went on a little bit of a tangent there. I'm just going to do a really brief intro to Nadex. It ties in a lot to what Mark was saying. And real quick before I start, risk disclosure. Hopefully you know trading involves risk. We've been focusing on that a lot. You put your money into a market, the market can take that money. You need to be sensible. You need to understand your risk. Even professional traders, I've seen, or people that are very experienced traders, I've seen them actually trade in products where they didn't actually fully understand what that potential risk could be. And particularly for individuals, whether you're just getting into trading, we've all done this. We've all made the mistakes. That's how we learn. We all have bad trades. And by the way, if you're not keeping track of your trades and you're not learning from your bad trades and analyzing those, you're missing out on valuable lessons. You've already lost the money. At least get something out of it. One thing on this risk disclosure you'll never see that you can lose more money than you have in your account, which you can if you're trading leveraged products. It can't happen at Nadex. So real quick, we are the North American Derivatives Exchange. We're based here in Chicago, and we're actually unique in that we're designed for the individual trader. The reason we were even founded in the first place, we wanted to provide fair market access in a sensible manner to experiences of all, or to traders of all experience levels with all levels of risk capital, right? We talked about value at risk. If you want to go trade oil on the CME is a great exchange. I've traded a lot there. But you better have some pretty deep pockets, right? Most exchanges are designed for those institutions or people that have quite a bit of wealth already accumulated. You look at the oil contract at $1,000 a point in the futures market, right? And you try to go trade that with a $10,000 account, good luck, bye-bye. You're not going to last long, right? That would be an example of not understanding your value at risk for your account to the size of the contract. And so what we wanted to do was take the most popular markets and offer a sensible way to access those markets. So how do we do that, right? Low cost of entry. The smaller contract sizes on the most popular markets, so things like stock index futures, commodities, currencies, smaller contract sizes, and clearly defined risk on every trade. Basically, as Mark said, when we look at the smaller contract sizes, it's an efficient use of capital, but you're also automatically prepared for what can happen. The risk of blowing up, well, that's still up to you, because if you have, let's say you have a $1,000 account and you put $1,000 into one trade, well, you can blow up pretty quickly, right? You should never do that. You still have to understand the principles of risk management. This is still trading, but if you do have that $1,000 account or $2,000 or $5,000 account, you can actually actively trade in a sensible manner. And you don't have to worry about that catastrophe. Now, one thing I want to point out that Mark said regarding cash, because we do work with a lot of individual traders, some that are maybe getting into the market, and I've seen this even with very experienced traders, I want to just reiterate one thing. Cash is a position. Just because you have money in your account doesn't mean it has to be dedicated to a trade, and oftentimes it shouldn't. You need to be patient. Cash is a position. I think oftentimes when people get in, they think, oh, trading should be exciting. And I'm going to say what a mentor of mine said a long time ago. If it's excited, if you're excited when you're trading, if your heart's racing and your palms are sweating, you're doing it wrong. Typically means you're taking on too much risk. So keep that in mind when you're trading. Cash is a position. All right, so a little bit more about us, and then I'll give you some resources, and happy to take questions for either myself or Mark, and then we'll wrap it up and let you get on your way. So we do offer 3 different contract types. We mentioned binary options. We just launched what are called touch brackets in January. It's a new contract. We're very excited about it. It's basically a floor and ceiling, and it's a knockout type of option. So it comes almost, it actually is that built-in trading plan. We kind of labeled it discipline for when you don't have it, right? Because I've seen so many times if somebody trades a market and they put in their order and then they put in a stop and then the market starts moving against them, they start moving the stop, or they have a mental stop and it never triggers. This actually gives you your absolute worst case scenario. The other side of that, we always talk about fear and greed. You get greedy, right? All of a sudden the market's running great in your favor, but you don't take profit, and then the next thing you know, it's back underneath where you entered, right? So if it hits either the floor or ceiling, depending on if you're long or short, you can automatically lock in profits. And then if you choose to, you can reopen the position, roll to the next contract. But I'm going to show you where you can get more information on these. And we also have a call spread contract. Ours are unique because you can do call spreads on a lot of exchanges, but these are actually designed to simplify an option strategy and package it as a single unit with a floor or ceiling. Underlying markets I already mentioned. We've got the global index futures, commodity futures, currencies, cryptocurrencies. We even do some contracts on events. So these are the three things. I'll show you where you can go to get more information. One, I'm a firm believer, as Mark mentioned, and I've seen this also in the numbers. A lot of times people want to open up an account and they just want to start trading. If you don't understand, one, the platform that you're trading on, two, the actual contracts, how they work, how are they structured, how is the risk defined, what does the risk reward profile look like? You need to understand the nuances. I believe you mentioned craft cheesy shells or something like that, reading the box. That's so true. I've seen it all the time. I've been working with individuals for about 20 years in this industry, and I've seen it too many times. I don't want you jumping in if you don't understand the contracts. So what we do is if you open up a demo account, this is right on the home screen at www.nadex.com. Open up a demo account. It's a lifetime demo account. I don't care if you ever open up a real account. Obviously, I'd love for that to happen. But we give you plenty of time. This isn't just a 2-week demo or a 1-month demo. Use it as long as you want. And in full disclosure, technically, if you applied today, I can't say it's a lifetime. If you applied today, I think it would expire in like the year 2057. So if you need an extension then, I would suggest call whoever's at the exchange and they can probably help you out. So that's right on the home screen. Open up a demo account. It's free. It takes about 30 seconds. Check out the platform. Also on our website, if you go to the Learning Center, and Mark, I'm going to reach out to you probably either tomorrow or next week because I want to get you on to do some more webinars with us as well. But we've got a lot of content. Underneath Learning Center, there's educational courses, webinars, and videos. Take some time, absorb that. Go through those as you're working on the demo platform. And those are really the resources. So let's see, hold on. I've got to pop out the questions here. Hold on, let me get to my, lost my cursor here for a second. All righty. Just wanted to bring up that screen since some questions are coming in here. Let's see, new to trade. So we've got the question. It's basically, I'll sum it up here. As far as for Nadex, if you're new to trading, it's favorable for newer traders. I really think it is. Now, I think Nadex is great, but I want to reiterate, you have to understand the contracts, right? Take some time, understand, like for instance, the binary option is an awesome contract. I've been talking about them since about end of 2007, early 2008. I've spent a lot of time with them. We've got a lot of strategies in our education center as well. But it's still a contract that involves risk. The great thing and why I think this is awesome for particularly newer traders or those that don't have much experience with the traditional options, you can learn the basics of options. Options can get very, very complex. We do our best to keep them as simple as possible, but they can be a bit overwhelming for some people starting out. If you're trading something like a binary option or a call spread, you can really start to understand how time impacts options, right? How volatility may impact the price of options. And so it's a great way to start. And because you can do it with a lower cost of capital, right? If you're a newer trader, used oil before or gold, or if you're trading like the E-mini S&P at 50 bucks a point, those can move really fast. And it can be difficult. You're going and you're swimming with the sharks at that point. You can come to Nadex, right? It still involves risk. There's no guarantees here that you're going to make money or be successful, but what we want to do is give you the best shot at being successful. So yeah, I think, and one of the great things, and you mentioned directional options traders. One of the great things about options as well, and we look at some different strategies, you can be direction neutral, right? As long as you can determine your risk, there are a lot of great strategies, whether you think the market's going up, down, you think it's not going to move at all, maybe you think it's going to stay on the channel, or maybe you think it's going to explode and you just don't know which direction. So take some time and learn those strategies because conditions change. And as Mark said, understand what you're going to do in each of those scenarios, and you should have that plan when you get into a trade for that respect. But yeah, I think it's a great place to start. And I'd also love to hear your feedback as you're taking a look at the platform and getting more involved with Nadex. And happy to take any more questions. As we said, this webinar is.
What do people trade the most? Binaries or the spreads? Most active.
Binaries definitely have the lion's share of the volume. The amazing thing, the call spreads have grown at the same rate as binary options for the years, as from volume. It's just binary options. We were known as the binary options exchange. That was where all of our marketing was focused. We're really changing that focus now because I think binary options are great and they have some great scenarios, but I think also if you learn the call spreads, there's other scenarios where you may want to use those or intertwine those. And with the touch brackets, we're really seeing a lot of good traction on those. Those actually are pretty much a mirror. You could almost consider them like a micro futures contract. We just launched them. I'm still working on bringing in some more market maker liquidity provider, which we should have a couple more up and running in those contracts in the next couple of weeks. So we'll see the bid offer spread get quite a bit tighter. But we're starting to see a little bit more leveling off. Forever, binary options were 95% of our volume. But the other stuff is picking up quite a bit of traction as well. Great question, by the way, Mark.
Thank you. Thank you very much.
All righty, cool. I think we've got the questions. We'll go ahead and I know, Mark, you were recording this, so if you want to end it on your side,
yep.
I will.